Hi, Paul Siebert here. Welcome back. So today I wanted to take you through one of the acquisitions we've worked on from start to finish. So I'm deliberately not naming the company because of confidentiality obligations, but everything else I'm going to discuss reflects the genuine transaction and the process that we followed. So my aim isn't simply to tell you what happened, but to explain why each decision was made and hopefully give you an insight into how professional acquisitions are actually structured. So one of the biggest misconceptions I hear is that buying sizable businesses does require an enormous amount of your own capital, and people often assume that if the company is generating 50 million plus of annual revenue, that the buyer must have written a check for tens of millions of pounds. In reality, acquisitions very rarely work like that, and the most successful transactions are normally built around intelligent structuring, understanding the motivations of the parties involved, and raising the appropriate institutional finance rather than simply relying on personal wealth. So this transaction is really a perfect example of that. So let's dive into it. So the business itself was a long established manufacturer with a heritage stretching back well over 100 years. It's built an outstanding reputation within the industry it's operated in and supplies many of the largest retailers in the UK, alongside a substantial network of independent stockists throughout the country. So the company employed several hundred people, operating from a large manufacturing facility, and has developed or had developed an enviable reputation for producing very high quality products with very strong customer service and long-standing relationships. Financially, it was generating annual revenues of approximately 50 million and EBITDA of around 3.2. So makes exactly the type of established cash generative business that institutional lenders are generally going to be comfortable supporting. Interestingly, this wasn't a business that had been formally brought to market. There was no auction process, no glossy sort of IM circulating to dozens of buyers, and no investment bank attempting to create a competitive tension between bidders. Instead, the opportunity was sourced completely off market through our own origination efforts, which is how I believe many of the best acquisitions are found. So one of the areas I think many buyers get wrong is that they spend almost all of their time reviewing broker mandates and businesses that everybody else is looking at. And whilst there's nothing inherently wrong with brokered opportunities, I guess the reality is that every private equity house, trade buyer, family office, wealthy entrepreneur is going to be reviewing exactly the same information. So that inevitably creates competition, it pushes valuations higher, and often leaves the seller controlling the entire process. My preference has always been to identify businesses that I would genuinely like to own before they officially become available, and then approach the shareholders directly. That process starts with understanding the industries rather than the individual companies. So we spent a significant amount of time researching the sectors that we believe possess the attractive long-term characteristics like this deal, before we identify the sort of strongest businesses within those markets. And once we've identified companies that fit our investment criteria, we begin researching the ownership structure. So is it business founder owned? Is there any succession issue? Is there private equity involvement? Has management already realised some value? Are the shareholders likely to be considering retirement or planning to an exit over the next few years? So these questions are often far more important than analysing historic accounts, because they determine whether there's likely to be an opportunity to transact in the first instance. So during our research on this one, we discovered that this particular business was majority owned by private equity, with the remaining equity held by members of the management team. And that immediately made the opportunity more interesting, because private equity firms are usually exceptional owners of businesses, but they, by their very nature, aren't permanent owners. Every investment fund has got a defined life cycle, and at some point, those investors need to realise their investment and return the capital to their own investors. So the fact that private equity had been invested in this business for several years suggested that there was, at least a possibility that an exit might be considered for the right buyer. So rather than sending a sort of generic email or making a sort of unsolicited telephone call, we decided to write directly to the chairman. The letter wasn't a sales document, and it certainly wasn't an offer to purchase the business. Its sole purpose was to introduce ourselves, explain our background, outline how we typically approach acquisitions, and express a genuine interest in discussing whether there was an opportunity to work together on a transaction. And the objective was simply to begin a conversation. Fortunately, the chairman responded relatively quickly and positively, and after a number of initial discussions, we agreed to meet. So, looking back, I think this illustrates an important point about acquisitions. The vast majority of transactions don't begin with negotiations over price; they begin with very much relationships. So, before anyone's prepared to discuss selling the business they've spent probably many years building, in many cases decades, they need confidence in the people sitting across the table. So, for that reason, our first meeting very much focused on entirely understanding the shareholders and the management team rather than discussing valuation. We wanted to understand why they were considering the sale, what they'd hoped to achieve, whether management wanted to remain involved after completion, and perhaps most importantly, what success looked like from their perspective. And those conversations often reveal far more than a set of financial statements are ever going to tell you, because they allow you to understand the motivations that will ultimately shape the transaction. So, what became apparent was that the private equity investor had reached the point where they wished to realise their investment and crystallise that value that they'd created over a number of years. The management team, however, had a rather different perspective. They were passionate about the business. They wanted continuity for employees and customers, and they were keen to remain involved following any change of ownership. So, understanding those differing objectives immediately started shaping how I believe the transaction should be structured, because a successful acquisition is rarely about achieving the lowest possible purchase price. It's really about finding a structure that allows every stakeholder to achieve their objectives. I also believe that buyers make a mistake when they're reluctant to discuss sort of how they intend to finance an acquisition. Some see this as sort of revealing too much information or maybe weakening their negotiation position. I've always taken the sort of opposite view. So I think transparency builds credibility. So during that first meeting, we explained that we generally structure acquisitions using a combination of institutional debt, asset-based lending, and seller financing. We also explained why that approach, I suppose, benefits everybody involved. Institutional debt is generally cheaper than equity. Seller financing demonstrates confidence in the future performance of the business, and if it's structured correctly, the business itself can support a significant proportion of the acquisition funding through its own future cash generation. So, by the end of the first meeting, we'd not agreed a valuation or signed any legal documentation or discussed any sort of commercial terms. However, something more important happened, I think, and I think really both sides had started to develop trust. And in my experience, trust is often the single most valuable asset in any acquisition process. So, second meeting was considerably more detailed and shifted the conversation away from the shareholders towards more about the business. So we spent several hours discussing the customer base, supply chain, the manufacturing process, labour requirements, production capacity, inventory management, working capital, competitive positioning, and future sort of growth opportunities. And the objective really was to determine not simply whether the business had performed well historically, but whether those earnings were genuinely sustainable and capable of supporting acquisition finance over the long term. So I think only once both parties really felt comfortable that there was a genuine basis for progressing those discussions did we enter a formal sort of NDA. So signing the NDA gave us access to more detailed financial and operational information, and marked the point at which the transaction moved from, I suppose, being an interesting conversation to becoming a genuine acquisition opportunity that required detailed underwriting, valuation, and financial analysis. So let's move on to that point: valuation, negotiation, and sort of structuring the transaction. So once the NDA had been signed, we were granted access to a significant amount of financial and operational information. And at this point, the acquisition stopped being about relationships and started becoming an underwriting exercise. So now we had to determine not only what the business was worth, but perhaps more importantly, what it was capable of supporting from a financing perspective. I think one mistake I see many inexperienced buyers make is that they immediately focus on EBITDA multiples. They'll hear that manufacturing businesses sell for 4, 5, maybe even 6 times EBITDA, and simply apply a multiple without actually understanding the quality of those earnings. In reality, two businesses generating exactly the same EBITDA can have dramatically different values depending on how resilient those earnings are and how much working capital they consume, and the quality of their customers and the strength of the balance sheet, as well as the level of sort of future investment that might be required. So before we even started thinking about valuation, we spent a considerable amount of time understanding the financial performance of the business. We analysed 3 years of historic accounts, management accounts, budgets and forecasts, and we're looking not just at revenue and profitability, but also the trends within the numbers. We wanted to really understand whether margins were improving or deteriorating, whether there was any customer concentration, whether that was increasing, how efficiently cash was being converted from profit, and whether there were any exceptional items that distorted those reported earnings. I think one of the most important concepts in acquisitions is understanding the difference between reported EBITDA and maintainable EBITDA. So reported EBITDA tells you what happened historically, whereas maintainable EBITDA is your view of what a prudent buyer should expect the business to generate going forward. And those two numbers aren't always the same. So, for example, a business may have benefited from one-off contracts or usually low raw material costs, or maybe a temporary reduction in labour expenses. And equally, there may have been in costs that will disappear following completion, such as private equity, management fees, exceptional legal or owner-specific expenditure. So the objective isn't to manipulate EBITDA upwards or downwards. The objective is really to try and establish a fair, sustainable earnings figure that both buyer and lender can, basically underwrite with confidence. So after carrying out that exercise, we concluded that the business was currently generating around 3.2 million of EBITDA, and there were both strengths and risks that needed to be reflected in our valuation. The company had an outstanding reputation, for example, a diversified customer base and an excellent market position. But like many manufacturing businesses, it also required significant working capital to operate. Inventory levels were quite substantial, debtor balances were quite high because of the scale of the business, and cash generation was heavily influenced by the timing of customer receipts and supplier payments. So none of these concerns in themselves, put us off the deal, but they were certainly important considerations because lenders ultimately will lend against cash generation rather than accounting profit. So having completed our analysis, our initial view was that a fair value for the business was approximately somewhere in the region of 15 million. That wasn't because we believed the company wasn't worth more. It reflected what we believe represented an appropriate balance between risk and return, taking into account both the quality of the earnings and the financing structure that we expected to put in place. And as often the case, sellers naturally had a higher expectation of value. They generally don't say yes to the first offer that they receive. They built an excellent business, invested many years of hard work, and they believed the future prospects justified a premium. So rather than becoming too entrenched over a difference of 1 million, which essentially was the gap, we started thinking about the transaction slightly differently. So one of the biggest lessons I've learned over the years is that experienced deal makers negotiate structure before they actually negotiate price. So most negotiations tend to focus almost exclusively on the headline number because that's the figure that everybody remembers, where in reality the purchase price is only one component of the transaction. Equally important is the amount that you're going to pay at completion, the timing of deferred payments, security, warranties, working capital adjustments, and the financial package supporting the acquisition. I think it soon became quite apparent in this case that if we would reduce the amount of cash required on completion, we could comfortably increase the overall consideration. So from the seller's perspective, that produced the valuation that they were seeking, but from a buyer's perspective, it significantly reduced the initial funding requirements while allowing the business itself to generate much of the cash required to pay the deferred. So this is where understanding, I suppose, the balance sheet became just as important as understanding the underlying profit and loss. So one figure, I suppose, stood out particularly in this example. The business had about 11.5 million of trade receivables. So this is the amount that a collection of customers owe the business at that particular point in time. So to many people, that simply appears as just a line on the balance sheet, but to an acquisition financier, it really represents security. So invoice finance is probably one of the most misunderstood forms of acquisition funding. Many people think that invoice finance is simply a facility used by distressed businesses to improve cash flow, and that couldn't be further from the truth. I think many exceptionally profitable businesses utilize invoice finance because it provides flexible funding directly linked to sales growth. The principle is quite simple, really. Rather than waiting 36 or even 90 days for customers to pay their invoices, a lender will advance a substantial proportion of those invoices immediately, and then as customers pay, the facility revolves and new invoices become eligible funding, and the result is that you have lending capacity that naturally increases as revenue grows. So when we analysed the debtor ledger, we concluded that approximately 8 million could be realised from the receivables through this type of finance. And when we actually completed, we also added a term loan to that. So basically took the total institutional funding to approximately 9 million at completion. And at this point, we'd effectively created the first layer of the capital stack. The next question then became, how do we bridge the remaining gap? So I suppose there's several ways of doing that. The buyer can introduce equity, third-party investor could provide maybe mezzanine financing, or alternatively, the seller can effectively finance part of the purchase price themselves. So we believe that the third option probably made the most amount of commercial sense. So seller financing is another area that's often misunderstood. Some interpret it as a sign that the buyer lacks funding, but in reality, seller financing can be extremely powerful because it aligns the interests of both parties. Look, if the sellers genuinely believe in the future of the business, then retaining, I suppose, an economic interest through having deferred consideration still owed to them demonstrates the confidence in their ongoing performance. So after a number of discussions, we agreed that approximately 7 million of the purchase price would be deferred and repaid over an agreed period. And that meant that the sellers still achieved their desired 16 million valuation, while the buyer only needed approximately 9 million on day one. So from a financing perspective, that, I suppose, transformed the transaction. Rather than asking lenders to finance the entire acquisition, we were asking them to finance only the amount supported by underlying assets and cash generation of the business. And that's a very different credit proposition. And it also meant that the sellers remained invested in a successful transition of the business, because a significant proportion of the proceeds would be received over time rather than immediately on completion. The final major commercial issue concerned the purchase price mechanism itself. So broadly speaking, there's two ways of buying a company. The traditional method uses completion accounts, where the final part of the purchase price is adjusted after completion based on actual cash, debt and working capital that's delivered. And the alternative is a lockbox structure. So after a lot of discussion, we agreed on the lockbox structure. So let's have a look at what that is all about. So a lockbox fixes the economic value of the business at a specific historic balance sheet date, and from that date onwards, the seller agrees not to remove any value from the company except for specifically agreed items, and this is known as permitted leakage. So if they do extract value outside of those agreed items, then they are required to compensate the buyer, and that I suppose the principal advantage to them is the certainty. Buyer knows exactly what they're paying, the seller knows exactly what they're receiving. So there's no requirement for lengthy completion accounts or disputes, several months after completion, which can often be expensive and quite contentious. A lockbox really places greater emphasis on due diligence, though, because the buyer effectively assumes economic risk from the locked box date onwards. So therefore, it becomes absolutely critical to understand the working capital position, ensure that there's robust leakage protections that are included within the legal documentation, and really satisfy yourself that there's no material deterioration that's occurred by completion. Personally, I've always liked lockbox transactions where the businesses got good financial reporting and both parties are acting in good faith. They certainly reduce uncertainty, they simplify the financing process, and it does allow everybody to focus on completing the acquisition rather than arguing over accounting adjustments months later. So I think by this stage, we'd achieved something really quite important. We hadn't simply just agreed a valuation, we designed an acquisition structure that worked for everybody involved. The sellers achieved the headline valuation that they wanted, the buyer significantly reduced the upfront funding requirement, lenders had a strong asset backing and predictable cash generation, management remained incentivized to ensure there was a smooth transaction, smooth transition following completion. And at that point, the commercial deal really had largely been agreed. I suppose the next challenge was then proving that every assumption we'd made could withstand the scrutiny of lawyers, accountants, and institutional lenders. And I guess that's where the real work then started to begin. So let's move on and talk about the due diligence, financial modelling, actually raising the money. So with the heads of terms agreed, we entered what I would describe as probably the most intensive stage of the transaction. So this is the point where the deal sort of moves away from negotiation into execution. I suppose every assumption that had underpinned a valuation now had to be tested, every risk identified, quantified, and every lender convinced that the acquisition represented a acceptable credit risk. So people often talk that due diligence is simply an accounting exercise. I think in reality, it's much broader than that. It's, the financial due diligence is only one part of the work stream. Alongside that, sits commercial due diligence, legal due diligence, tax due diligence, operational due diligence, environmental reviews, insurance policy reviews, property reviews, management due diligence. And the objective is not just to prove that the business is perfect, because no business ever is. The objective really is to understand exactly what you're buying and ensure that there's no surprises after completion. So one of the first things we did was build a comprehensive due diligence list. We wanted to review statutory accounts, monthly management accounts, budgets, forecasts, age debtor, creditor reports, customer contracts, supplier agreements, property leases, insurance schedules, tax computations, VAT records, employee information, health and safety documentation, and a lot more. So I think by the time we've reviewed everything, we've probably looked at over 400 sort of individual documents covering every aspect of the business. So people sometimes ask me whether due diligence is about finding reasons not to do the deal. I don't really see it that way. I think if you're looking for reasons not to buy a business, you'll always find them. Every company is going to have issues. Every company is going to have risks. The question isn't whether the risk exists. The question is whether you understand them and whether they can be managed appropriately. So as we worked through the documentation, the overall impression was extremely positive. This was a professionally managed manufacturing business with good reporting disciplines, well-documented operational procedures, and a very experienced management team. I think the quality of the information probably gave lenders more confidence because it demonstrated that management really understood the business and they had the appropriate controls in place. There was definitely good governance, and I guess good governance may not increase the valuation directly, but it certainly reduces the perceived risks, and lenders pay a great deal of attention to that. So that doesn't mean that everything was perfect. There was certainly a number of areas that required further investigation. One example related to intellectual property. So some of the design registrations that protected the company's product portfolio were actually held in the name of another group company, so rather than the acquisition vehicle itself. So that doesn't necessarily mean anything's wrong. It just may simply reflect a historical group structure or an internal licensing arrangement. However, from a buyer's perspective, you can simply not just assume that valuable intellectual property transfers automatically. So we required legal confirmation that all that material intellectual property would transfer with the acquisition, or be subject to legally enforceable licenses following completion. And where appropriate, we obviously sought additional warranty indemnities within the share purchase agreement to protect against that future dispute. Tax was another important area. We spent a considerable amount of time reconciling corp tax to deferred tax balances and working capital adjustments. And again, we weren't looking for problems for the sake of it. We simply just wanted to have complete clarity regarding what liabilities would remain with the company on completion and which liabilities would be settled by the sellers. I think one of the biggest causes of post-completion disputes is really ambiguity. So the more certainty you create before completion, the smoother the transaction becomes afterwards. We then reviewed the share capital of the company in detail. So this might sound like a relatively straightforward exercise, but it's quite surprising really how common there is for historic share issues or option schemes or employee incentive arrangements, which create complexity during the acquisitions. So we wanted to ensure that every issued share reconciled with the statutory register, company's house filings and legal documentation, so that there was absolute certainty regarding the ownership was actually, what the ownership was and what was actually being acquired. So that might seem like a small administrative exercise, but it's fundamental if you're buying 100% of a business, because you need to have complete confidence that you're really buying 100%. Operationally, one of the biggest focuses was on customer concentration. The business had excellent relationships with several major national retailers, which were clearly a strength, but the concentration always creates dependency. So if one major customer represents a significant proportion of turnover, then lenders naturally want to understand the stability of those relationships and the length of contracts, the historical trading patterns, and the likelihood of future business. So we analysed customer trends, historical revenues and management relationships with those key accounts to really ensure that there was no undue concentration risk that could ultimately undermine future cash generation. Working capital probably received more attention than any other area of due diligence, because in manufacturing businesses, working capital is effectively the fuel that keeps the business operating. Inventory's got to be purchased, products need to be manufactured, customers need to be invoiced, suppliers need to be paid long before potentially cash is ultimately collected. So understanding how that cash cycle operates is very critical because it directly affects the amount of external funding that's required. And then one concept that many first-time acquirers really do struggle with is the normalized working capital. Sellers will often argue that whatever the level of working capital exists at completion should simply transfer with the business, where buyers maybe take a different view. The business should be delivered with sufficient working capital to operate normally from day one, and if the sellers, reduce inventory, for example, immediately before completion, or delay paying suppliers, or even accelerate debtor collection, it's quite simple to maximise the cash that they're going to extract, and then the buyer inherits a business that requires, additional funding. So that's precisely why the definition of normalised working capital becomes such an important negotiation within the share purchase agreement, because we had agreed a lockbox structure. And that became even more important. We spent considerable time ensuring that there was appropriate protections around leakage, dividends, management charges, etc., so that we could really make sure that the business, between the lockbox date and legal completion, was delivered with sufficient working capital. And the objective wasn't to make life difficult for the sellers; it was simply to preserve the economics that both parties had agreed when the transaction was negotiated. And alongside the due diligence, we built what I believe to be one of the most valuable tools in any acquisition, which is a fully integrated three-way financial model. So I often say that spreadsheets don't complete acquisitions, but they do provide confidence. So a properly constructed three-way model links the P&L, the balance sheet, and the cash flow statement. So every assumption flows through that entire business. So, if revenue changes, if inventory changes, how does that affect working capital? And if working capital changes, what are the changes in impact on cash? And if the cash changes, how does that impact on debt? So everything is very much connected. So the reason that this very much matters is lenders don't lend against historical accounts, they're lending against future cash flow. So our model is therefore projecting not only revenue and EBITDA, but also debtor collections, creditor payments, inventory movements, capital expenditure, corp tax, interest costs, debt amortization, and covenants compliance throughout the life of those facilities. So we built, downside scenarios within that model, because lenders never assume that everything's going to go according to plan. They want to understand what happens if revenue falls by 10%, if margins come under pressure, or if debtor collections slow unexpectedly. I think one of the key outputs from the model was that the debt service ratio. So earlier I explained that the business generated about 2.4 million of cash before debt service, allowing for a corporation tax and capex. So against annual debt repayments of approximately 1.8 million, the debt service coverage ratio is 1.33 times. So you essentially divide EBITDA by the total amount of debt, both interest and capital repayment, and within that is obviously you've got your deferred seller note. So what that demonstrated was that the transaction was serviceable. It also reinforced, I suppose, the importance of maintaining lender headroom and making sure that we were structuring things realistically based on those repayment profiles. So the model also became the foundation for our discussions with lenders. So rather than representing simple information, sort of simple IM, we were able to demonstrate precisely how the business generated cash, how the debt reduced over time, and how different trading scenarios affected the financing structure. And that really did significantly increase lender confidence, because I suppose they felt every assumption could be tested rather than just simply accepted. So the funding process, we approached a number of institutional lenders, and this is, I guess, another area where I think many people, acquirers, make mistakes. They often tend to speak to one lender, they receive an indicative offer, and then just proceed from there. We prefer to create competition wherever possible, so we basically spoke to multiple lenders. They're invited to review the opportunity. Each received the same financial information. Each was given the opportunity to propose its own funding structure. And that process basically yielded us 4 separate funding offers. The benefit wasn't simply achieving maybe a lower interest rate, but certainly that helps. Different lenders, I suppose, have different views regarding leverage, advance rates and covenants, amortization profiles and security packages. So having multiple offers allowed us to compare not just pricing, but also the overall quality of each proposal. So eventually we selected the lender that we believe offered the best balance between leverage, commercial flexibility and execution. And there was very little point achieving a marginally cheaper pricing if the lender can't deliver on time. So certainty of funding is often worth considerably more than a slightly lower interest margin. So even once a preferred lender had been selected, negotiations continued. So facility agreements needed to be drafted, security documents negotiated, and all the sort of conditions precedent needed to be satisfied, and of course agreeing all the financial covenants. So we spent quite a lot of time negotiating the covenant levels, because covenants should really protect lenders without unnecessarily restricting management's ability to operate the business. There's no benefit really to either party in agreeing a covenants that are so aggressive that they're likely to be breached during an ordinary trading cycle. So I think by this stage the transaction had become a coordinated exercise involving the lawyers, the accountants, the lenders, the management team, the shareholders and the advisors, and really it was all about working towards the same completion date. So every work stream I suppose depended on another work stream, and maintaining the momentum became almost as important as solving the technical issues themselves. So I think it's at this point that acquisitions are either successfully managed to completion or gradually sort of lose that momentum through delay or uncertainty or poor communication. So from our perspective, maintaining a sort of clear timetable, resolving issues as they arose, ensuring every party understood what remained outstanding, meant that we reached a point where only the legal completion mechanics remained. And the final stage is often the most satisfying, because I suppose after months of analysis and negotiation and structuring, you finally move from planning the acquisition to actually owning the business. So here we are at completion. What happens next? And what are the sort of key lessons that we took away that might be useful to other deal makers. I think by this point so this was sort of the beginning of July 2026. We've been working on the transaction for several months. I think heads of terms had been agreed towards the end of February. Lender proposals had been received during March. Due diligence had been completed sort of by early April, and then all of the legal negotiation and documentation and financing packages were sort of finished during sort of April, May and June. So from the outside, it might appear that completion is simply just a matter of signing a few documents and transferring some money. In reality, completion is a culmination of hundreds of individual work streams that have all come together to, I suppose, at the exact right moment. So one of the things people rarely appreciate is that even a few days before completion, there can still be dozens of outstanding matters. There can be conditions precedent that need to be satisfied, lender security documents that need to be signed, corporate approvals obtained, fund flow statements agreed, disclosure letters finalised, insurance arrangements confirmed, completion accounts or lockbox confirmations reviewed, and it's entirely normal for transaction checklists to contain many open items until the final sort of hours of completion. So that doesn't necessarily indicate that the deal is in trouble. It's just a simple reality of coordinating lawyers, accountants, lenders, management teams and shareholders across multiple organisations. And I suppose the role of the deal lead, i.e. us, during that period really does change significantly. I think earlier in the transaction, the emphasis was on valuation, negotiation and structuring, and at completion, it tends to be more about project management and ultimately making sure every advisor has the ability to meet the deadlines that we have all agreed. So every outstanding issue has got its dependencies, and I guess a delay in one area will have consequences somewhere else, particularly when lenders are involved, because they won't want to release funds until every condition's been satisfied. And I think one of the most important skills in acquisitions is therefore maintaining that momentum. Deals rarely fail because of one major issue. More often than not, it's because they lose momentum through delay, uncertainty or poor communication, or until one party decides to walk away. I think fortunately this transaction continued progressing in a positive direction. Legal teams worked through the remaining documentation. Lenders confirmed they were satisfied with the due diligence findings, and all of the sort of funding documentation was agreed. And once those final conditions precedent had been satisfied, funds could be released. So the funding itself followed the structure that we'd negotiated several months earlier. So approximately 9 million was advanced at completion through a combination of invoice finance and senior term debt, where the balance of the consideration that remained payable was through deferred seller financing. And this is worth emphasising because many people still assume acquisitions are funded entirely with equity. They're not, and in many professional structured acquisitions, the capital stack consists of several different sources of funding, each serving a different purpose and each carrying a different risk profile. So the senior lender was comfortable because a substantial proportion of its lending was secured against a high quality debtor ledger. The seller accepted the deferred consideration because they had confidence in the underlying business and because it enabled them to achieve the headline valuation they wanted. This ultimately led to the buyer acquiring an established market leading business that without introducing the entire purchase price in equity on day one. So, in other words, everybody achieved their commercial objectives because the structure had been designed around the sort of motivations of each party rather than forcing everybody into the same sort of solution. I think one area that surprises people is that completion is not the end of the transaction. In many respects, it actually is the beginning. Ownership changes overnight, but the business, doesn't operate any differently just because shares certificates have changed hands. Customers still expect delivery, suppliers still expect payment, employees still expect stability, and a successful acquisition therefore does depend just as much on post-completion integration as it does on the actual negotiation that's taken place before completion. I think one of the reasons we were comfortable with this transaction was the willingness of management to basically remain involved. Continuity is an enormously valuable part of a transaction, particularly within a manufacturing business where that operational knowledge has been built over many, many years. So retaining that experienced management team significantly reduces the transaction risk because customer relationships, supplier relationships, operational expertise remain with the business while ownership changes behind the scenes. Let's talk about sort of key lessons. So I think looking back at the transaction, I think when I've done now 110 transactions, and every one I think I learned something new with, and I guess that gives me greater experience and helps with the next deal. So I think looking back at this specific transaction, there's probably several lessons that I think apply not only to this acquisition, but almost every business purchase I've probably ever been involved in. So I think the first is that proprietary deal origination remains one of the greatest competitive advantages to any acquirer. The opportunity began with a carefully researched letter to the chairman rather than a competitive auction. Approaching businesses directly before they formally come to market gives buyers that opportunity to build relationships, understand the motivations, and negotiate transactions without competing against numerous other bidders. And that generally results in more sensible valuations and significantly greater flexibility around structure. I think the second lesson for me is that understanding that motivation is more valuable than negotiating on the price. If we'd focus solely on reducing the purchase price from 16 to 15 million, there's every possibility that the transaction would never have completed. Instead, I guess we recognise that the sellers cared just as much about the certainty and the legacy in achieving their desired evaluation as they did about the amount of cash that they received on day one. So by solving those issues through that deferred consideration, everybody achieved a better outcome. I think the third lesson is one that I believed for many years and I suppose was just cemented really with this transaction and reinforced. Structure is almost always matters more than valuation. I often see buyers spending weeks negotiating the final few £100,000 of purchase price whilst paying very little attention to the actual payment timing or working capital protections or warranties or security or financing terms. And those areas frequently have got much greater impact on the overall economics of a transaction than the actual headline valuation itself. A business purchase for 16 million with excellent funding terms may represent significant better acquisition than maybe the same business purchase for 15 million, but requiring the entire consideration in cash on completion. I think the fourth lesson concerns due diligence. To many people, due diligence is an obstacle to completion, or a process designed to kill deals. I've never viewed it that way. I think good due diligence allows transactions to complete because it identifies risks early enough for them to be managed appropriately. So during this acquisition, we identified a number of issues relating to intellectual property and tax, as well as working capital and corporate structure that needed to be addressed. And none of those matters ultimately prevented the acquisition. They just simply influenced how the legal documentation was drafted and what warranties were obtained and how the transaction was then structured. That's exactly how due diligence should really work. I think the fifth lesson is cash flow is more important than profit. You know, accounting profit is undoubtedly important, but lenders are repaid with cash, not EBITDA. So throughout the transaction, we spent considerable time analysing working capital, debtor collections, capital expenditure, and then sort of, you know, looking at the debt service capability making adjustments accordingly. I think businesses fail because they run out of cash, not because they report lower accounting profits. Sixth lesson is very much relationships remain fundamental to successful acquisitions. I think looking back, I don't believe this transaction completed simply because we produced a good financial model or negotiated a clever funding structure. I think it completed because trust developed between all parties. You know, shareholders trusted that we would deliver what we promised. The lenders trusted the quality of our analysis. Management trusted that the future of the business would be protected. Lawyers trusted that the commercial arrangements would remain consistent throughout the process. And trust is, difficult to measure, but it's, I think, one of the most valuable assets in any acquisition. Finally, I think that this transaction demonstrates that buying business is rarely about having the deepest pockets. It's about understanding businesses, understanding people, understanding capital. The ability to combine all of those disciplines is, I suppose, what separates professional acquirers from everyone else. So I think if you can identify good businesses directly, not through brokers, build relationships with shareholders, structure funding intelligently, and manage the risk, you can complete acquisitions that many people assume just are simply beyond reach. And if there's one message I'd like people to take away from this case study is that acquisitions are not mysterious. You know, they're a structured process. They require a lot of preparation, discipline, patience, and attention to detail, but they're not reserved solely for the largest private equity houses or multinational corporations. You know, the principles are exactly the same whether you're acquiring a 5 million revenue business or a 500 million revenue business. I think the scale changes, but the underlying discipline remains remarkably similar. So I hope you found this case study has given you genuine insight into how, you know, one acquisition progressed from that unsolicited letter to the chairman through to a completed transaction. And over the coming months, I intend to produce further case studies covering other transactions that we've dealt with so far this year in different industries with different funding and different structures in different jurisdictions. Some will be completed, successfully. Other case studies we'll look at will show when deals have fallen apart. And I actually think that there's just as much to learn from a deal that never completes as to one that actually does. So if you found this useful, I'd really appreciate you subscribing to the channel or letting me know in the comments which aspects of acquisitions you'd like me to cover next, whether it's seller finance, asset-based lending, financial modelling, due diligence, negotiation, strategy, or raising finance. I'm always happy to produce content that helps demystify the acquisition process. So thanks for watching, and I'll see you in the next video.